Good afternoon. So by way of introduction, I'm Peter Davey. I lead innovation and labs at the clearinghouse. So I'm here to talk to you guys a little bit about payments and how we are transforming the payments industry to something that's now a 21st century payments ecosystem. So for those of you who aren't familiar with the clearinghouse, some of you probably aren't, we're the oldest company, oldest fintech in existence. In the payments industry, obviously. We actually were formed in 1853 by the New York Money Center banks to establish the first clearing and settlement system for the US. So that predates the Federal Reserve by about 50 years. And our primary competitor is the Federal Reserve. We clear and settle $2 trillion a day for financial institutions, which means that most of the payments that actually traverse the payments networks actually clear or settle over our rails or the Federal Reserve's rails. It's about 50-50 if you really look at the volume going through there. And we do more than just payment systems. We also provide advocacy for the industry in moving things forward. And in my role as innovation, I help to actually open up doors to create new capabilities that financial institutions and their partners can leverage. Another thing about the clearinghouse is important to understand. We're owned by the top 23 financial institutions in the US, but we don't pay dividends back to those financial institutions. We're a liability on their balance sheets. We actually run as a cost recovery model. If you're familiar with that accounting treatment, it basically is a not-for-profit. So just in case you understood where that comes from is, they fund us for things to develop. We actually repay them back for those funds to develop, but no dividends actually ever go out to the financial institutions that own us. So you guys went and talked a whole lot about banking in the last section, right? And who wants to go out and run and become a banker, right? It's a tough thing, right? So you probably are wondering in yourselves, you're all fintechs for the most part, some financial institutions maybe, or you work for a financial institution, but you're probably wondering why the ecosystem is so broken, right? And why banks in general, because you probably want to partner with financial institutions, don't move as quickly as you would expect them to. Well, this guy here, Chris Skinner, who I think is a really good thought-provoking guy, the reason why banks don't really do well today, and the reason why they haven't transformed, is because they were built in a paper-based world. And because of that paper-based world, they now need to migrate to digital technologies. So a lot of what you just heard in the last session was financial institutions have to replace out what was old with what's new. And that takes a long time when you look at all the services and things that they provide to customers today, which actually gives the best opportunity for financial institutions to actually partner with fintechs if they're forward-looking financial institutions. So if any of you wondered where payments came from, bartering was the first form of payment back in before the Common Era. You then started with crude metal coins, right? So we're advancing these things over time period. Precious metal coins came into existence in 70 before Common Era. In the year 806, paper money was actually first established. The wampum in 1535, Native Americans used that as a form of exchanging to be able to, or now indigenous people. 1717 was the first printed checks. We're still trying to get rid of checks, right? Talk about paper-based, that's lasting a long time. In 1816, we decided that gold was valuable, so we started using gold as a commodity to be able to trade and actually had value to it. In 1872, the first wire transfer happened, and we continue to do wire transfers today, but by another means as opposed to over a telephone line. In 1913, we had the gold-backed US dollar, so that was when actually the value of money was linked to gold as opposed to now, which it's in God we trust, or at least in the government we trust, right? 1920, the first charge card was introduced. 1950, the first credit card was introduced. Any extra points for who actually was the first credit card issuer? It's close. Bank of America, actually. So, in 1971, we then moved away from the gold-backed US dollar. In 1974, the ACH network was introduced. So if you wonder why the ACH network is so slow and archaic, think about using a computer from 1974 and the way that it was programmed to be able to do things. And then you figure out why you can't modernize some of these old infrastructures that exist. 1994, we started our first online commerce. 1997 are the first mobile payments. We're still in the edge of trying to get mobile payments really out there and promoted across. In 2008, blockchain came about. And then in 2017, we developed the RTP network. And I'm going to talk a little bit about why we developed the RTP network and what it will do for you. But I go through all of this to kind of prove out the point that one thing that we don't do is ever get rid of anything. To be quite honest, most of this stuff really still exists, doesn't it? It's changed in terms of how it exists, but it still exists. So it means that we as developers have to contend with multiple networks in order to actually be able to accomplish things, right? And most of those have problems with them that we try to overcome through other uses of technology. And one of the new things around integrating new payment systems is that you're still going to have to support some of the old things that are out there for quite some time. So let's talk about why RTP needs to exist and why we developed the application for financial institutions and partners to leverage. First and foremost, technology is moving at such a great clip, and there's a need for immediacy. So when you think about things like connected devices, for example, in 1974, none of us were really connected to the internet. In 2021, only 7% of the entire US economy is not connected to the internet. That means that pretty much everybody who wants a phone who can connect to the internet is there, which means that the instantaneous nature of data is important to all of us. We are now learned to say, if it doesn't happen immediately, something's wrong, right? And we need that transparency in order to be able to drive that forward. And connected devices are one of the reasons why that actually is been training our brains to think in that manner, right? So if you look at all of the different ways in which you're going to connect, all of these different applications and all of these different devices, in some instances, might be able to do payments. And in order to actually accomplish that in a meaningful way and to know that something actually gets done, you need to have bilateral communication for that to happen. It can't just be throw something into a network and hope in 3 or 4 days that it comes back, right? You want to be able to do things with surety and have those applications present. Artificial intelligence is another reason why we need new applications, right? Because in general, we are starting to automate more things that don't require human intervention to be able to do that. And we're doing that through the use of artificial intelligence. So robotic process automation, cognitive automation, and ultimately true artificial intelligence. The goal is to try to not have humans do menial work anymore. And in that particular instance, you need more data in order to actually perform those functions in a fairly good fashion. So I think artificial intelligence really leans you to need more data and to need bilateral communication within your payment systems. And certainly the addition of natural language processing, which now allows us to potentially do a payment from anywhere, whether it's tell our car, whether it's tell our Alexa device, whether it's tell our Google device, whether it's in our office and we're on a webinar and we want to do something, right? The idea is that with natural language processing, we've unleashed now the ability for humans to interact with technology on a real-time basis and get immediate feedback on the way things are happening, right? So all of these technologies are kind of coming together to be able to drive us to do more things. So there have been some innovations on the payments rails and some of the current rails that have existed for the past 40 and 50 years, right? We developed same-day ACH. That allowed us to, during business hours only, and during non-bank holidays and non-weekends, to now clear a transaction in a batch format on the same day. Well, the reality of that is that helps out financial institutions, but it doesn't necessarily put money into the customer's account with immediacy, right? There are some other applications that we've developed over time. Many of you use on a daily basis when you're transacting. One of them is MasterCard Send. The other one's Visa Direct, right? What we did is we took a card network that only was able to pull money, basically say, hey, here's money coming from your account, or here's money coming from a lending line. And we said, why don't we just change the way that that transaction is traveling and allow it now to come in and post to an account. So that was some technology that was put in around 2008 through the card networks, and now a lot of folks leverage that in order to try to do immediate push payments. The challenge with that is that it doesn't change the settlement engine. So what that means is you're actually leaving somebody with risk on the side of the transaction because you're asking them to post a transaction that doesn't have finality in the settlement side of it. So that, in general, creates more risk within the ecosystem. And you have to de-risk those things. And a lot of the things on the card networks don't actually settle transactions. Card networks basically collect information and then settle transactions using traditional rails like wire transfer, like ACH, and now RTP. So why do all of you exist for the most part in terms of driving new financial technology? It's because the changing needs of the customer, right? Customers now, we've talked about the technology and how that's influenced. Now we have to think about how customers think and what their expectation is. So customers are looking for technologies that are always on. We're connected to the internet 24/7. We want to be able to pick up our phone and do anything we want at any time we want, right? Businesses are now operating around the clock in many cases, especially on the international side of things. Technologies need to be digital native. In order for us to get the most out of these technologies, we have to be able to harness the power of that data, which means that things that aren't digital in nature or things that we have to exit to perform on a manual function really don't help us all that much in terms of actually getting away from the ability to do manual processes. We need to start creating insights through artificial intelligence. Again, you need something that's data rich to be able to do this, because this now helps us, and I think the discussion at the end of the last presentation was a really good one about how do we actually reach our customers? How do we actually do the things that we did in relationship banking way back when? And the majority of us are going to do that through harnessing the power of data, leveraging artificial intelligence to be able to do that. But that means we need access to more data in order to be able to perform those functions. Things need to be tailored. We don't have necessarily a penchant to go through processes that don't actually work in our favor. So therefore, you want to be able to tailor these things to customers, and that's both on the business side as well as on the consumer side. Technologies need to be omnipresent. This means that we're now harnessing and bringing multiple technologies together to be able to allow for a customer to be able to access anything anytime they want. So if I pick up my phone and I talk to my bank through Google, and then I go to my house and I talk through my bank through Alexa, or I've got a system in the back office that's connecting through APIs to do balance reporting, all of that stuff has to be able to exist together. And to be able to provide for better data. Technologies need to now be embedded. So if you're looking on the B2B front, massive opportunity to fix a lot of problems in the B2B industry. The idea here is that now these things need to be embedded in the applications that customers are using. Customers don't want to exit the application they're using for their job to go and log into their bank to do a transaction that's disaggregated from that process. And last time, it needs to be in real time. So in order for us to actually be able to close out a job, for example, I'm paying somebody, right? That example of paying somebody, I can't really do that in a batch process because then I'm still waiting for information to come back to me to be able to then complete the transaction. And God forbid that transaction doesn't go to the right place or it fails. I don't have visibility in that for a couple of days, right? So the ability to do that in real time, close out the transaction, move on to the next thing is keenly important in the customer's mindset. So let's talk about the importance of real-time payment systems. So we developed the RTP network, launched it in November of 2017. This was after we got the mandate from our financial institutions in 2014. November of 2014 to be exact, to build out a new payment rail for the US. This journey actually started much longer before that. In about 2011, we were asked by our supervisory board, who made CEOs of the top 25 financial institution, to look at what the industry needed. We already knew that what we had wasn't going to sustain us in a digital age. We knew that the lack of information, the lack of immediacy, the lack of transparency, all of those things were problems. So this wasn't a reactive thing. This was a proactive approach to be able to develop this. We then decided that we would go ahead and build this in 2014, launched it in 2017, and now our competitor, the Federal Reserve, will have their version of instant payments available sometime in 2023 as well. And we've been operating beside the Federal Reserve for hundreds of years. We'll continue to do that as real-time payments evolve. The good news is their specifications are very similar to our specifications, so it's not like there's going to be a lot of waste across the industry on that. But what does real-time payments do? It provides for immediate funds availability. This is for all parties, not just for the bank. So the idea here when we designed the system is that it couldn't just go at the bank level and be considered done. It had to be applied to the customer account. So this means that funds travel from one account at one financial institution to another account at another financial institution instantaneously with atomic settlement between those financial institutions once that transaction is accepted by the other one. And there's a round trip message to the sending financial institution that says, I've accepted that transaction and I'm posting it to the customer's account. The unparalleled amount of transparency that you now have to make sure that a transaction is completed is really what we were striving for. It couldn't just be immediate, it had to be immediate, final, and had to be transparent to the customer. And then it also had to provide for more data. So the challenge with the card networks, they're pretty old. You can only carry so many things on an 85, 83 record set. We realized that we couldn't build something on old technologies, so we leveraged ISO 20022 as the newest technology or the newest message specifications to be able to do this. The great news about that, every other country around the world is leveraging ISO 20022 for their payment switches, including the upgrade that the UK is doing, which is one of the first to go forward and faster payments. And that means that we can actually start to create some interoperability. Does anybody know why we can't create interoperability easily on the ACH networks? We're the only one that has an ACH network the way it works. Everybody else has a different batch payment system with different record specifications that don't work. So having the ISO 20022 message set gives us a leg up in terms of creating global interoperability for payments on a real-time basis. Now there's a lot of other complexities that need to be figured out in terms of how settlement works between different countries as things are happening, because again, the most important point is when you send a transaction, the funds have to be good. The funds have to be final. So in that particular instance, you want to make sure that you have that ability to settle those transactions on those rails. So RTP sits alongside our other payment systems, right? I told you we don't necessarily get rid of anything. So we still have check image exchange, we still have ACH, and we still have wire. RTP becomes a new tool that we can leverage. And in my estimation, RTP will become the more popular tool as you embed it into more technologies, and therefore it becomes seamless for a customer to use those technologies. So where do we stand today in terms of adoption of the RTP network? Well, right now, as we sit today, we're about 61% of the entire US deposit base has access to be able to receive an RTP transaction. What you see on that blue shaded map is really where the saturation exists for these particular networks to be able to communicate with customers. We are over 150 financial institutions on top of the network today. We continue to add about 50 a quarter, depending on the processors and or third parties that are actually onboarding these customers. And there's over 800 plus registered routing numbers on the network. If you want to see more about RTP or read more about it, our website is a brilliant place to go, theclearinghouse.org. We have message specifications on there. We actually disclose the pricing of an RTP transaction. We have some nice videos that show you how it works as well. So if you want to look at more of that, you can certainly talk to me, or we can actually explore the resources on the website. So how does RTP differentiate itself from other platforms like Zelle? Well, first of all, Zelle now clears over the RTP network, which is a really good thing. It also leverages ACH in some instances for folks that leverage ACH still. And it also leverages the card networks to reach and create reach. Zelle is a platform that sits on top of multi-rail, similar to what the credit card system does today. RTP supports all use cases. This means that no matter what you want to develop, it will actually work over the RTP rails as long as you're leveraging the message specifications the right way. So we have seen in all of these instances the way in which RTP is being used, and certainly there's more use cases than that. It's use case agnostic, which means that it is a tool and a technology that you can use to develop applications. The messages really are the roadblocks to this. And if all we had was a faster payment, we only have a single part of that transaction that just became faster. There's not much innovation in that other than having instant and final settlement is actually a good thing for transactions to complete. So the rest of the messages are what really excite me in terms of new product design and innovation. So what we did was we developed a highly intelligent rail that allows for customers to communicate with each other. So that means being able to do something like a request for payment. So we don't have debits on this network. The reason we don't have debits on this network is because real-time debits with irrevocability is a bad idea. Fraud, risk, everything that rolls into that. So what we did is we developed a better tool for that called request for payment. The request for payment message allows for me to ask somebody in a non-obligatory fashion for money. So that means that I can present a bill on the RTP network to a customer. I can present an invoice to an RTP network for work that's been done right now. And then I can have that customer at their financial institution, once that receives, respond back to that. And if that wasn't good enough, we can now also confirm with the person that the transaction was received and posted. So all of that now happens seamlessly through the RTP network, through the messages that we've built onto those things. And the majority of the way that you guys will actually leverage these tools are through financial institutions or through third parties that have built APIs that allow for the onboarding of transactions into the network. So let's talk a little bit about request for payment. Request for payment, as I mentioned, is a non-obligatory ask of money. It allows for senders and receivers to communicate over the network, the same network that they're going to make the payment. And it allows for context to be set to allow for straight-through processing. So if you look at the entire procure-to-pay process in the B2B space, and you actually are able to issue an invoice on top of a contract, and that is able to be sucked into the back office system of that corporation, it's able to go through their process internally to get approved to go out, and then that transaction can be scheduled and then affected in real time to the other party. So when you look at the innovation of what you can create there and the goo that you take out of the process of somebody getting an invoice through a manual process, then applying that invoice in a subsystem, then taking that information after it's applied and approved, and then putting that back into the payment system, you can actually drive all that context in a much more rich environment. Yes, we're going to talk about that too. So that's actually even more exciting information to provide to you. Requests for payments, again, use case agnostic. They can be used across any different amount of use cases. And here are just a few that we've looked at: P2P, B2B, B2C, C2B, and then ultimately G2C and G2B, right? So think about tax payments, being able to submit tax payments through there, getting a request from the tax agency for the amount that you owe, not having to go onto a network to pay something remotely that is non-contextual. Again, all industries can leverage these technologies to be able to create more seamless applications. So the RTP brand promise, why do people want to use these? In the case of bill pay, it's frankly because there's actually benefit on both parties' fronts to be able to leverage these technologies if fintechs, banks make these available to the end customers. So on the bill payer side, the ability to have immediacy, control, that they're informed about what's happening and it's a secure place to do it. Because we all know the email is the most insecure place to receive information, right? When people are trying to rip us off every single day leveraging email, I'd rather receive those things that are financial in my life through my financial institution or through the party that my financial institution is leveraging, because I can do that in a safe, secure environment and not have that data taken out of context. On the biller side, thinking about the person sending the bill, they have more immediacy on the cash flow. When that transaction turns around and comes back in, that's instant cash flow. In many cases, billers are applying transactions today when they receive them through an ACH network coming in, or when they actually send the ACH debit out, and they don't have use of those funds for a number of days. If you do that, if you're Verizon, for example, and you do that for your 387 million subscribers or whatever, that's a lot of money that you're putting out that you're actually lending to a customer over a period of time while you're waiting for that transaction to come in and clear through the door. Visibility and control, efficiency, I think is the biggest gain. And then certainly, I think a more superior customer service, because now not only can you get paid in real time, but you can now affect bill payment in real time, and all parties are actually true in the transaction. So what would that look like on a biller's website? Kind of similar to what an ACH transaction would look like today, except instead of an ACH debit, what it would do is you can actually validate through the routing number that somebody can receive a request for payment. You would send the request for payment out, much like you would a bill, an e-bill, and that would be able to be received at the customer's financial institution. What would that look like? And these are the apps that folks are developing today. That would look like, I got a request for payment, pops up on my phone, I click pay, I open up my banking app, I'm able to actually look at the details of the transaction, including the base level details here. I'm able to potentially look at an invoice or a bill that's presented with it, and I'm going to talk a little bit more about that. Decide when I want to pay it, and then allow that for that transaction to go back out the door to the biller. From a biller perspective, all the information that they need back to be able to process that transaction straight through is already attached to the message. So all of that's already embedded within the request for payment, which means that all that information, that rich information that they sent, is coming back to them so that they can actually apply the payment without having to have a lot of extra processes. Industry is looking for real-time technologies, and vast majority of folks consider real-time payments, extensive remittance, along with payment information to be either very important or important. And that's not a surprise to anybody, right? We all want more data to be able to do things with, and the rich data features of the network allow for that data to be appended to it. So I was talking a little bit about the B2B life cycle, right? In a lot of cases right now, you have multiple ways in which you actually receive invoices, you then process invoices and make payments. RTP helps to connect those things so that you don't have all of these substandard processes that actually create a lot of goo within there. Now, what that means is that these things can integrate into parties like AvidXchange. They can integrate into things like Oracle or SAP and Ariba. That's really where the power of all of this comes together, is when you actually embed those things in the back office processes so that I don't have to handle this as an AP or AR clerk. I tell CFOs all the time, the value of RTP for them is that they can redeploy an entire organization of folks once they're able to achieve that economy of scale, right? So that's really the promise of it. And if we were to enable RTP on the majority of businesses, and we were able to take the goo out of what happens in a procure-to-pay process today, you're talking about adding trillions of dollars back into the industry. That's an exciting value proposition for all of us, because you as fintechs are out there looking for billions of dollars to be able to actually develop new applications. And that's where the value comes in of you guys doing the work that you do every single day. So I told you I'd come back to the idea of attaching more information to an RTP message. Well, one of the things that I realized very early on when we developed the RTP network, we put out a remittance message called a PAX or a REMT 001 message. It's a ISO message. But what do people not do really well today? They don't actually transfer that information back to the end customer in a form that makes it consumable. And what's the issue with that? Well, not all financial institutions are able to support that type of data transfer. So putting that same data on a real-time payments network, if financial institutions aren't really good at doing that, doesn't really do us any good, does it? So that rich data is still trapped within there. But what do most companies know how to do today? Most companies know how to develop a PDF for a bill, right? So you can take a vectored PDF and send that along with the message. Or you can actually produce an STP 820 file that gets put into an XML file and can be ingested on the other side. So what I decided to do is build out a new service called Document Services. It's something that will be available toward the end of this year in a pilot fashion, and then hopefully in production by the middle of next year. And what this allows me to do as a sender of a request for payment or a sender of a payment message is actually append a digital document to that to be ingested on the other side by the end party. So that allows me to now send a PDF over the same network that I'm sending the request for payment, which has the summary information in it, so that I can perfect myself in terms of looking at an invoice or looking at a bill and decide whether I want to pay that. Even better yet, once that comes in, I can have an AI agent read it and make sure that it actually matches everything that I want to do before I actually send the payment to go back out on the network. The way that that would work, ultimately, is I would actually attach a bill. It would use a common set of APIs. That common set of APIs would be exposed to the end users so that they can actually upload the bill. They would then get a GUID to be able to include on the request for payment transaction. That GUID would resonate to whatever that secure bill detail is. And then on the receive side, when I receive that GUID, I can then use the same set of APIs to retrieve that document, leveraging that GUID in a secure fashion and present it to the customer or feed it into a source system. So the idea here is to stop embedding a whole lot of information that needs to be used for perfection of these types of transactions inside the record and help to unleash it so that folks can actually deal with documents or XML files that allow them to actually build these things together. So we'll kind of bring this home. What do all these things then have in common as we think about all these new technologies and how they exist? Well, first of all, it leads to new business models, leads to new products, leads to new services and new experiences. And things like connected cars allow for commerce to now happen seamlessly. So being able to take data from the car, say, hey, I need to go fill up. It then routes me to the nearest gas station. It authorizes the pump for the amount of gas I need to have. I confirm it with my voice. I'm able to go in, pump my gas, and leave, right? These are the types of models that can exist that actually can transform all of our lives and take things out of our lives that we don't need to do anymore. And part of that is wasting time, right? Half the technology of this already exists within our cars and vehicles today, right? Think about the whole COVID thing. We did a lot of remote doctor's visits during COVID. And doctors have started to leverage these types of technologies to be able to allow for seamless integration of all of these things. So now I can talk to my doctor over a Zoom call. I can have that go in there. I can process my copay instantaneously. The doctor sends the request for payment as we're talking with them. They go and issue a prescription. That prescription gets delivered to my door, and I've been able to pay all of those things without having to actually ever leave my house or without having to pull out information to type it into a subsystem, right? The procure-to-pay process, the collections process, all can be taken care of seamlessly by actually pulling these technologies together. So I'm happy to take any questions, and I thank you for listening, and hopefully you found this to be helpful. Please.
So what does it take to get like the long tail of banks on board with all the small community banks? That's where a lot of us customers probably are that we want.
Yeah, I think you heard earlier from the previous speaker that there's definitely going to be a lot of consolidation in the industry. I think part of the challenge with financial institutions, you have to convince multiple levels within financial institutions that change needs to happen. The largest of the financial institutions are already there, right? So, the bulk of financial institutions that are on the 100 or so makes up 61% of the deposit base. There is a long tail, though. Every financial institution afterwards, if I want to get 1% of rate, and we'll be about with the number of financial institutions we're bringing on this year, we should be somewhere close to 75 or 80% of all deposits on there. So that's a ripe environment. I mean, 61%, and if you looked at the market slide, some might be closer to 100. There's a lot to do today in terms of like being able to develop applications that work really well in those environments. But if we're at about 75 to 80% by the end of the year, to get one more percentage point on that, that means you have to onboard another almost 1,000 financial institutions, right? So what we've done is we've worked with financial technology providers who actually sell these systems into financial institutions. We've worked with third parties like Fiserv, FIS, Jack Henry, and a few other cores to be able to deploy these technologies. And for example, with our friends over at Jack Henry, we can get a bank up and running if they're on one of their cores in less than 5 days. So what we're trying to do is make sure that we are connecting with as many people as possible so that these technologies can be more seamlessly deployed. And in many cases, we're looking at potentially helping to drive prudential standards by making sure that things are connected in, that we're actually out there. We've developed some services with a company called Akoya, if you've heard of them, on the consumer banking side. Akoya is a API gateway hub that's connecting financial institutions and fintechs together for the purposes of balance reporting, token provisioning, and potentially even payment provisioning. So if you're not talking to Akoya today, you probably should. Plaid serves a similar role, but in many cases they don't have direct connections to all the financial institutions. We'll have 11 up by the middle of next year. That will at least be able to do some sort of real-time information reporting through that API hub. I'm looking to do the same thing on the B2B side. Quite honestly, the B2B space is a mess. There's too many different players in it. So if I can set up an API hub to help connect financial institutions and service providers and fintechs together so that all that stuff comes in seamlessly, it deploys the tools into your hands. So to that end, I'm actually establishing a labs environment that will allow us to start working with fintechs a little bit more directly, allow them to prove out those points, and then help hopefully find financial institutions to work with to deploy those new technologies. So. Right. So think about like an API for sending a request for payment. You can embed microservices in there that include tokenization, it includes validation, and then it also allows for you to affect that data transfer in the way that you need to do that. Any other questions? I'll go back to you first. Both great questions. So first of all, I'll address the fraud question. We've actually flipped fraud on its head, right? So by moving away from debit pull environment into something that is a response mechanism like a request for payment, we're ultimately putting the power into the customer's hands to make the decision as to whether or not that's a good transaction. On the send side, because it's a credit push transaction, the liability goes to the send side financial institution. So that means that the most prevalent amount of fraud that's going to happen is account takeover fraud, which means that they have to have the right things in place. But on the receive side, very little fraud because you're receiving money that you're able to apply cash in a irrevocable manner. So in general, it should be more fraud proof than prone if financial institutions and their technology providers are protecting the front door to the financial institution. And that's really where the most power is, because if I'm the customer and I'm pushing my own money, it's less fraud prone than me actually handing out credentials to somebody else and having them household those credentials for the purposes of pulling money from my account whenever they want to, right? So I think fraud, for one, is we flipped the paradigm a bit. And the nice thing about a real-time environment is that you can actually detect fraud faster because you're looking at single transactions as opposed to waiting for batch processes to actually finish up before you're able to scrutinize all those transactions as well. So in general, the fraud models should actually be in a place where they're in real-time scanning before transactions go out the door, which should prevent most of the fraud from happening. And then what we are also doing is we're building out some data modeling that would allow for that to come back to the financial institutions so that they can actually scrutinize their transactions after the fact as well to make sure that they're actually developing their models in a more robust manner. We're building models that financial institutions can leverage, but we're not going to do that directly as a network. As a network provider, we shouldn't be the ones that tell you whether or not a transaction can complete based on fraud. That should be up to the customer and their financial institution. The only thing we should be able to tell you is whether or not you can complete that transaction because there's no money there. On the ubiquity side, so we're already seeing financial institutions who are leveraging RTP, especially even on the send side. Payroll is actually a big example right now. People are moving toward more of a real-time payroll model. With that payroll model, we're actually seeing people leave their banks if they're not on RTP and going to an RTP bank to be able to have that applied. So it's almost self-healing because as these technologies become there, people are going to be asking for them or they're going to migrate away to customers that do have them. To the point around the send side though, that is the more difficult piece. That means that your applications have to be built to be able to allow for these things to send. And that's, to be quite honest, where all of you guys come into play. You can develop those applications, you can partner with financial institutions, and you can help that to be able to drive forward. And so what the Valley Bank guy was talking about earlier, sort of help them leapfrog the problem that exists today with the fact that their technology is archaic and they're waiting for third parties to potentially develop new applications. So I think there's a willingness to partner now. We've seen it from the majority of financial institutions, except for that one Texas bank he was talking about. But I think you're going to find very willing participants in many cases if you can help them see the value for their customers in developing new applications.
So the requested payment side, if I understand that correctly, that's to get paid.
Yep.
So is there a signal where you're showing intent to pay?
So yeah, there actually is a message called a Paying 14 message, which is a response to a request for payment. So if I'm especially in the B2B environment, it might be good to be able to model when I'm going to actually see those payments forward. So financial institutions or third parties could deploy a message that would say, I have intent to pay you on X date. That can come back to them, and then when the payment goes out, obviously you could reconcile or complete that. Now it's not a promise to pay because you could always change your mind, send a new Paying 14. But the idea is that you should be able to bilaterally communicate all of those things back and forth between the parties.
That's interesting because a lot of fragmentation is at the small business level.
Yeah.
Where pretty much the same banks for folks who are sitting on liquidity, and I want to play that piece. So it's a good growth strategy.
Yeah, absolutely. And there's no hiding the fact that instant liquidity is a good reason for people to move to there, especially in the small business marketplace, which in my opinion is the most underserved marketplace in the US. Probably globally too, but please.
Because you're sending with that attached document, because that's coming along sort of everything you need to do that.
Right.
Where's that document stored in the interim? Does it have a time to life?
It does have a time to life. We've designed it initially as a temporal environment, so think about 90 days or less for that document to live, because the long-term storage of that document should be at either side of the party that need to exchange that document. That's their job to do that, not my job to necessarily maintain that long-term. So there is a 90-day limit that we've put on those documents being transferred. It is a cloud-based service with the APIs, one of the open framework, but it's obviously ultra secure in terms of how that gets done. As the document's being ingested, it's completely encrypted. Not only does it go over an encrypted channel, but as the document's ingested and scanned, it goes into an encrypted format that can't actually be undone until the GUID is retrieved on the other side. No worries. Any other questions? Please. Yeah, we could probably have like 5 or 6 hour conversation on that particular topic. Ultimately, I mean, cryptocurrencies are trying to solve a trust issue in many cases. The majority of Federal Reserve dollars that move through the U.S. are already digital in nature. They're not paper. And what that means is that you're really not necessarily solving much of a need on that side. Now, there are some really cool things with smart contracts that I think can actually pair very well with RTP. So having smart contracts, even using a GUID to be able to unlock the smart contract in many cases, to be able to view there or have multi-parties. If you think about the scenario I was talking about with connected things, if they're reporting on things that you need to be able to do, like monitoring a shipping container, all of that stuff is stored in the smart contract. When that shipping container gets there, it's been validated, you can execute atomically on the RTP network to be able to solve for that need, right? So I think a lot of things compare together when you look at these technologies. Personally, when I look at central bank digital currency or I look at cryptocurrency, I feel like in many cases it's solving a problem that doesn't exist. And so that's my own personal bias. We've written a nice white paper on CBDCs you can find on our website. I think it's a pretty pragmatic approach if you want to know at least what we think about CBDCs. Any questions? Well, thank you guys. Appreciate it.